It is a bubble. It is time to take some money off the table.
I sold off 25% of my upside and I eliminated 100% of my downside, which is a lot of fun.
Welcome back to the Vancouver Resource Investment Conference.
As you've both been in the industry for a long time, I think we should start there. What's different about this time?
I think the difference between this and the 1970 bull market is that virtually no one came into that market with any experience. We hadn't had an economy that was interested in extractive industries literally since before the Depression. So we came into 1970, perhaps it was just me that came into 1970 completely unprepared. People who are coming into this bull market, some of us, the ones that are my age, or which includes these guys, were in the 1970s bull market. They were in that wonderful market in the beginning of the 1990s. They were in the bull market 2000 to 2010. So I would suggest that many of the participants in this bull market, yourself excluded because you're too young, have some experience. We know what a bull market feels like. We know what to do in a bull market. I think it's highly unlikely that the three guys on the stage will ride the stocks all the way up and then all the way back down. You will see this group, I think, come out of this bull market with some cash intact.
Yeah, one of the things about this bull market is that the internet has allowed everyone to participate. You know, back when I started in the 70s and 80s, it was the George Cross newsletter or Northern Miner is how you get your data as to what was going on. Now with the internet, everyone can participate. You get real-time data, people are able to make their decisions. And there's also a real quality of newsletter writers out there. Many are geologists, and so they're understanding the deposits, so you get a much better dialogue around projects that people make decisions on in a much timely manner than certainly I experienced back in the 70s.
Okay, how about you, Ross? Thanks for joining us.
Let's first of all start and say this particular bull market with metal prices where they are today is you know, it's not sort of like a bull market, it's a bull market on steroids. I mean, who would have believed $100 silver, $5,000 gold? You know, I did hear a few people who I felt were on the very fringe of the business predicting these kind of things, but I, you know, rationally never believe it would happen. So we're not only in a bull market, we're in a real, for me, somewhat of a bubble market. Now, is it going to change? Probably not for a while. Ultimately, it will. As Rick said, we are, you know, this business is a cyclical business. Metal prices go up and they go down. There is demand and there is supply, and they both have to be included in any equation of what position we are at any point in time in the market. Is it a bubble, or is it something on the way up or on the way down? These happy times like we're having today are wonderful, but we've all lived through times that were exactly the opposite. We had, you know, difficult markets, no capital, lousy metal prices, and, you know, we all remember, at least some of us remember, the original bull market that I was kind of on the fringe of, which was actually the late 70s. And in the late 70s, gold hit all-time highs, oil prices hit all-time highs, and there was a whole huge amount of froth in the late 70s. Well, it exploded in 1981 and 82 very quickly. Silver went from $50 down to, I think, a bottom of $4 rather quickly. Gold went from, what, 700, Rick? $700 or $800 an ounce down to $250 an ounce. And we had these beautiful bumper stickers, you might remember, in Alberta that said, you know, God give me another bull market. I promise not to screw that one up. And it's true, you know, you only know you're at the top after the fact. But from my standpoint today, it is a bubble. It is a frothy market. It is time to take some money off the table, I think. Probably not all, because I think we have more room to run. But we are not in the early innings of this game. We're in the late innings, and we'll see what happens. But nobody can predict the future very well, but my bet is that we are in a bubble condition for sure.
Okay, so starting with you, Ross, on this next question, what signals are you looking at that gives you that perspective that we're in the late innings?
Have you seen the metal prices? And the stock market valuations? Thank you.
Okay, thank you. Bob, how about you? Where do you think we're at in this bull market? Do you think we're late innings? Do you agree with Ross here?
I would think, again, when you look at the charts of the metal prices, and if you look at something like the GDXJ, where it was 15 years ago, we're reaching those highs up again. But I would agree with Ross that there's still some time to go within it because of the fact that we're still undervested. If you look at a lot of money globally, there's only a small component that's in the precious metal space. And when you look at the amount of treasuries that are out there, they're starting to look for places to invest with hard assets. And it's something that we can certainly provide both in the precious metal space, but certainly in copper, right? It's one of the most critical of minerals or metals, the way we need to use it. So I still think there's areas in this market to be able to make money on, and there's still potential to go upside. But when you look at the velocity with which metal prices have moved up, it certainly has been pretty quick over a very short period of time.
Okay, yeah, thank you for sharing that. So how about you, Mr. Rule? I know you've been taking some profits and getting some hate for free, but just curious in your perspective.
At this conference last year, I told people I expected a pretty good market. Jay Martin asked me what that meant, and I said, well, I wouldn't be surprised to see the resource equity index is up 30% this year. Well, I was wrong, mercifully. What I think you need to consider is that escalation in share prices probably front-loaded some of the performance that we thought we'd see over 4 or 5 years. I don't believe this bull market is over, but I think it needs more than a rest. The circumstances that took gold higher are intact, I think. But I also think that a lot of the price appreciation that I thought would happen in 25, 26, 27, and 28 all happened in 25. And so I guess what I'm trying to say is that I think the secular bull market in precious metals and raw materials continues, but I think it takes a break. And let me put a break in context. In the decade of the 70s, the spectacular bull market, really over 10 or 11 years, in the middle of that bull market in 1975, the gold price fell by half. And that's part of a bull market. If you aren't financially and psychologically prepared to deal with 30% or 35% declines or 50% declines, you really got to get some money in the bank now, because you're going to experience that. You just flat are going to experience that. I've done business with these two guys since the 80s and 90s. I've made a lot of money with them, a lot of money. And I don't think I've ever owned a stock run by either of the two of them that hasn't shown me a 50% share price decline during the time I owned it. But at the same time, I've had a lot of 10-baggers with these guys in stocks where I experienced a 50% decline. So think of this bull market as a rodeo ride, and think of yourself not as the bull, but rather as the bull rider.
Yeah, you don't want to get knocked off that bull for sure. So, Rick, you mentioned you see the dollar depreciating by 75% of its value. And so how are you factoring that into this current bull market?
Daryl points out that my thesis has been that as a consequence of negative real U.S. interest rates, that the dollar loses 75% of its absolute purchasing power over 10 years. I think that's very much intact. That was the experience in the 1970s. By the way, that's absolute value. I think the Canuck buck would be lucky to only do as bad as the US dollar. What that means is that the investments that worked for you very well in the period 1982 to 2022, long bonds as an example, will be a very bad place to be for the next 10 years. I don't think that people should curl up in the corner in fetal position and moan. I think you just need to understand that the next 10 years will be less benign than the last 40 have been. I also think, despite the fact that gold has gone up, that people have to own some. I own a lot, and I personally hope it goes down in price. Gold does well when confidence in fiat-denominated savings products goes down. And circumstances where people are afraid are not normally good circumstances.
Okay, thanks for sharing that. Bob, what do you think about Rick's thesis there? 75%, the dollar.
Well, I guess on a relative basis, one would, can see that occurring. I take a look at the fact that the U.S. debt to GDP continues to increase at a high rate. The same even in China. The China debt to GDP is actually accelerating a little bit higher. So you're taking all of this debt on, and as a consequence of that, people want to start looking for other areas in which to able to deploy their capital. And that's why I said earlier, I think, the precious metal space and certainly the physical metal space is going to be able to see that trade when you're seeing the total value of all mining companies at a few trillions of dollars, and with the many, hundreds of trillions of dollars of debt out there, it needs another place to be able to go. And, governments just aren't efficient at how they're spending money, and so people want to look at other places to be able to deploy it.
Okay. How about you, Ross? I'm curious if we got any optimism on the dollar on this panel.
Right. Well, I have to say right now, I'm an older guy like both Bob and Rick, and I've seen a lot of cycles. We've been through this a lot. I've started a lot of companies. I'm more of a company builder like Bob than an investor per se. But of course, companies do well when metal prices do well, and so you have to kind of be involved in the investing cycle as well when you start companies. But I've always started companies sort of at the bottom of the cycle, believing that prices would rise, and if you build a company full of assets, you're going to do very, very well when they rise. And this would be a contrarian view, because when you start a company at the bottom of a market, the market is saying it's going to stay low forever. This market is a sine wave. This business we're in, it operates like a sine wave. But because I'm older now, there are also things that are happening in the market that I really don't fully understand. I couldn't understand the flow of money into cryptos, for example. A massive amount of money went into cryptos and still is going into cryptos, and I couldn't really understand the fundamental value for that as an investment proposition. I do sort of on the edge, but it seems odd. Meme stocks, same thing. The valuations we're seeing in the AI stocks today is another example. It's just sort of bizarre that these valuations are so high for these companies that are fundamentally research companies. Of course, the 7 companies that dominated the stock market in the last 5 years on the U.S. side had these crazy, crazy valuations. The Amazons, the Facebooks, just one after another that I couldn't quite understand the valuations for. But because of that, I think we are sort of in a different world today. Things are moving, to Bob's point, way more quickly. Information flow is instantaneous. There's a lot more money in the business that can come in and can come out. There's a lot more passive investing, which never existed in most of my career. These are new forces that are influencing the market today. And those forces are creating this. Some of that force has come in to the metals business, has come into the mining investment business, or the stocks in this business. And we're seeing this extraordinary volatility that, like, I've never seen before. We're seeing a flow of money coming in and going out very quickly. It's in right now, and I think it will be in for a long time. But it is late in the cycle. It is late in what would normally be, like an 8-year cycle, peak to peak or trough to trough. the gold market, this particular gold market, for example, bottomed in, I think it was 2015. It bounced out of that in 2016. The bottom was 1,050, I think, something like that. Well, we're almost 5 times higher than that today. It's an for me, it's an unprecedented bull market, really equivalent to sort of what was going on in the 70s, as Rick said, but I wasn't really involved in the market then particularly. So, we are kind of in a new world. For me, a new world for many people. What can happen in the future, it's a bit of a uncharted territory for me. To Bob's point, and to Rick's point, there's a lot of forces out there that are still very, very bullish for precious metals, and therefore precious metals companies. A year ago or 2 years ago here, I was whining about the fact that we had this strange disconnect between metal prices and stocks. Metal prices were high and stocks were low. They hadn't reflected the rise in metal prices. Well, all of a sudden, starting in about July this past year, the last 6 months, bingo. We've had this correction, metal prices have risen, and stock prices have risen at the same time, or even more. And that's kind of a normal reaction that should have happened a year ago or 2 years ago, and it was puzzling me why it wasn't happening. And finally, that has caught up. Nature has asserted itself. Things have reverted to mean, and that's going on, which is the normal financial markets. But all this other stuff, it's such a new world today. There's so much more money flowing around quickly. Information's quick. I'm a little confused, but I still think the fundamentals are very, very good for continuing strength in this market. It is a bubble, yes. It is a bull market, yes. It will correct sometime, yes. It's a very smart thing to take some money off the table today. Get your capital back. Let the other money run. We know that we'll wake up one day and all of a sudden the party will be over. And we'll say, geez, I wish I'd sold it all. I mean, that always happens. And then we get this horrible, horrible grind. Year after year after year, markets go down and down and down and down. And it's just an awful, awful place to be. But right now, let's party, let's have a good time, but remember, good times do turn into bad fairly quickly. We've all lived through this many times, and it's a very prudent thing to just clip a little bit of that coupon, take a bit of money off the table.
All right. Well, I'm definitely ready to have a good time. Hopefully one of you pick up the bill. All right, let's all right, so Rick, I want to talk a little bit about when to take profits in the bull market, because you were getting some hate for free online for taking profits, and there's nothing wrong with taking profits. And also in your experience, you've seen these huge declines and such, and so like for me and what I know about you, you're very savvy in that way where you're able to reduce that risk going forward. And so what should investors be thinking about when taking profits off the table?
The first thing, Daryl, as you know, I've been active in a sort of a social media experiment since 2011. And what I've learned on social media is when I attract a lot of hate, I'm doing something just right. If you're a contrarian and your actions generate sort of 20-to-1 hate, you go harder. If you purport to be a contrarian, you got to look at contrarian signs. And if you're doing something that people are so unfamiliar with that it provokes rage, you're right in the fairway. So as you suggest, in October of this year, when the market was in melt-up, I decided that life had been too easy for me. And I disciplined myself to sell 25% of my junior portfolio. First of all, there was immediate gratification because people were outraged, so I knew I was doing right. But I did it because by selling 25% of my portfolio, I could withdraw all the capital I had in the game, every bit. So I sold off 25% of my upside, and I eliminated 100% of my downside, which is a lot of fun. And then just last week, when the silver market was in melt-up, I sold 80% of my physical silver for the same reason. Could it go higher? Yeah. Probably should go higher. That doesn't matter to me. My job is to take a nice big fat slug out of the middle. And I've been through a lot of bull markets. As you know, Daryl, I've graded almost 100,000 portfolios. I grade portfolios for free. And if you grade 100,000 portfolios over 35 years, you see what investors and speculators get wrong. And if you think about it, maybe you apply some of the knowledge of the mistakes that people make to avoid making those mistakes yourself. People are really, in a bull market, impacted by fear of missing out. And fear of missing out has cost people more money than anything I can think of.
Yeah, thanks for sharing that. So with the time we have left, I do want to make room for Bob, Dakota Gold. So could you share a little bit about that?
Yeah, for sure. Dakota Gold is involved in the Homestake District in South Dakota. It's an area that hasn't been explored for over 30 years. And when Rick and I were involved in Silver Standard, the area you want to go is a place where no one's been doing any work, and we were very successful with Silver Standard. We're in private land, we're in an existing mining jurisdiction, and as a consequence of that, we have a great team we've been able to put together, and we're developing our Richmond Hill project, which we think will be one of the next projects to be placed in production in the United States. So we've got a track record to be able to move it along into production. And then we have this historic Homestake District, which produced over 40 million ounces, probably some of the richest land in the United States. And I say with our 48,000 acres, we're well positioned that we've been able to go pick up an old mining camp that no one's been looking at. And being in a state which has mining going on allows you to be able to go through that permitting process. But being on private land is so important in the United States because it's a different tangent for permitting than you'd have elsewhere. So I came out of retirement 5 years to be able to do this project, the largest shareholder, and I'm really excited about the team and drill results and the opportunities we have at us, particularly in this gold bull market right now.
Okay, thanks for sharing that. Ross, Equinox.
Well, I didn't realize we were going to give a little pitch on our favorite deals, but This is sort of my only deal right now that I'm in the market on. Equinox Gold, many people here know, I think we started it 8 years ago almost to this day, in Vancouver to try to build a new big company, big gold mining company, and we're pretty well there. We just nudged 1 million ounces last year, just slightly less, but that was my original target, and then we sold some mines in Brazil. We just closed that a couple of days ago for $1 billion. And so we'll produce about sort of 700, 800,000 ounces this year from mines. A couple of big mines in Canada, one in the States, one in Mexico, and a couple in Nicaragua. But it's a big company now, and it's got lots of room to run. You know, it's a very nice time to be in the business as a big gold producer, of course. And I'll tell you one way that it helps. So we had about $1.5 billion US of debt 3 months ago, or 2 months ago, something like that. And we should clear, by the end of Q1 this year, zero. We should have no net debt in the company. So we sold, some assets. That helped, of course, but also cash flow is fabulous, and it's a great time to be in the market. Our big problem now is going to be allocation of capital, how we spend the free cash that we have in 2026. It's a very nice problem to have. Very, very nice problem to have. So the company's built, it's big, it's strong, very liquid. It's about a $16 billion market cap now. I'm really happy about it.
Yeah. So since you all like to go in and out of retirement, Rick, you decided to come out of retirement and start a bank.
Yeah, Daryl, if you ever decide to retire, don't start a bank. That's not a leisure activity. One of the things, at the beginning of this conversation, Daryl, you asked me about the difference between this bull market and earlier bull markets. The thing that's good about this bull market is that you have entrepreneurs who you've done business with for 40 years, like these two. I remember very well when I first met Ross Beatty, he had something that was also called Equinox. And I remember that we had to slam through the market to exercise some warrants to pay your late bill and the rent. And I mean, we had to work hard to put $300,000 in his treasury, and now he's raising money $1 billion at a crack. And if you employ big amounts of money with good people, happy outcomes happen over time. Same thing with Bob Quartermain. The first private placement I think we did with Bob Quartermain, it was not $2 million, I don't think. Maybe it was $2 million. And now people in their wisdom are giving him money, $100 million at a crack, and allowing him to employ the money over 5 years. And good people employing good money on good assets in good markets are bad, has a happy ending, as far as I'm concerned. High quality people, well capitalized, good assets. What you don't want to do is be late in this market with a company that's run, by the lame, the halt, and the blind.
Yeah, definitely. Well, I appreciate you all for your time and giving your insights on this market, your wisdom, as this is not your first bull market. So, audience, let's give it up for these gentlemen here.